What's up everyone, it's Scotty with Money Investing. In this video, I wanted to talk a little bit about the S&P 500, go over some really interesting data points, valuations, talk about the AAII survey among individual investors, and more importantly, talk about individual stocks, the Magnificent Seven, and if this happens, then we are in for a very interesting rough ride in the markets as well. So hope you guys enjoyed this video, find it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. Link to our Discord and Patreon is going to be down below if you're interested in joining us. And of course, getting access to all the buy and sell alerts, options alerts, trade ideas, everything's going to be included, as well as the intrinsic value spreadsheets, and not to mention private videos and tutorials and a lot of other educational videos as well. There is a 16% annual discount that you can access, of course, until the end of this month. So this right here is something that Tom Lee mentioned. There is a lot of profit taking on stocks today, and that is creating a lot of angst. But the S&P 500 has been relentlessly advancing. It is okay for the market to have a down day. And that's exactly what I mentioned. There's been a lot of profit taking today. As you can see, that a lot of big tech companies definitely were the ones selling off. The Magnificent Sevens, of course, Microsoft, Nvidia, Google, Meta, Amazon, Tesla, Apple, AMD, all these companies selling off pretty aggressively on the back of Tesla and Netflix's earnings. But all that money sort of like rotated out of those names and into consumer defenses and healthcares and energy, utilities, and financials. And those were the sectors that actually performed really well. They were the ones that were pushing higher on the day, and a lot of profit taking on these stocks more specifically because they have obviously rallied quite a bit on a year-to-date basis. Now, this right here was the AAII survey, which has now turned very, very greedy. Bulls now outnumber bears by 30%, and the largest positive spread since April of 2021. Last fall, bears outnumber bulls by 43%. What changed? A 30% rally in the S&P 500. So this is very much a contrarian indicator because it is so important to understand market sentiment. And that's really what drives expectations, which drives reality. And right now you'll notice and kind of focus on the specific dates. If you come back here and you notice that bulls now outnumber bears by 30%, the largest positive spread since April of 2021. And what happened in October, November of 2021? The bear market started. We topped out in the S&P 500. The bear market started. The entirety of 2022 was brutal. And then look what happened last fall, which was October, November, which is fall of 2022. Bears outnumbered the bulls by 43%. And then what happened? The market bottomed out and then started rallying. So the fact that we are now at a 30% increase in bulls versus the bears definitely goes to show that there is some caution advised here, considering that we have already moved up so much. S&P, the Nasdaq have rallied so much, and we need to be cautious. There is a lot of greed out there. There is a lot of exposure for active managers. So this right here, active managers had less than 20% exposure to equities last October, and today their equity exposure has jumped above 99% with the S&P 500 above 4,500. This is the highest exposure since November of 2021, right? And so as I mentioned in one of my previous videos, everybody who wanted to buy stocks has already bought, right? Where's the new money going to come from? Where are the new investors going to come from? That's the real question. That's what we have to answer moving forward, because if there isn't going to be any new money, if there isn't going to be a lot of investors buying now, what's going to happen? There's going to eventually be some level of profit taking, which obviously results in a day like today, where a lot of big tech companies that are up like hundreds of percent, you're seeing them sell off pretty aggressively, and that money is rotating into more defensive and healthcare and cyclical sort of sectors, utilities, so to speak, in the markets as well. So there's a lot of rotation going on at the moment. Now, this right here was another data point which suggested that 5-month win streaks can mean more strength for the S&P 500. So right now, if you come over to the S&P 500, if you go over to the monthly chart, you'll notice that right now we are in our 5th month. So starting with March of 23, 1, 2, 3, 4, and 5. So this is July. So if the market ends up green this month, in the month of July, chances of us pushing higher even further are substantially higher. So what this means is the signal date, again, this is 5 months of consistent rallies. What the markets have done 1 month later, 3 months later, 6 months later, and 12 months later. So a year from now, if July ends up green in the next sort of 2 weeks here, 2 trading weeks, If the market ends up green, which the S&P 500 right now is up 1.9%, so it's not a big gain. If we just need to hold on to that gain. If the market ends up strong and positive in the month of July, that's 5 consecutive months. Next 12 months, the probability for us to be higher is 93%. 93% probability the markets are going to be higher 1 year from at the end of July if we end up green this month. And only twice this has failed, and this has been in 2021, of course, and 1972. 2021, again, the market topped in October, November of 2021, of course, started this entire bear market. But even on a 1 month basis, 3 month basis, 6 month basis, the probabilities are very high with over 78, 67%, 82%, of course, 92, 93% as well. Now, very important indicators to watch and pay attention to. First of all, individual stocks. The only way we're going to be able to close green in the month of July is if a lot of these individual stocks hold up their overall uptrend. There's a lot on the line here for these companies, and they need to validate their 21 EMA. If Apple starts to break down below this 21 exponential moving average, so again, you can see that there's been a lot of support validation here, perfect, respecting that 21 EMA, bouncing higher, buying the dip, buying the dip, buying the dip, and then this right here is where we are once again coming down to potentially retest that 21 EMA at 189. So if you do see a breakdown below this, then unfortunately, I wouldn't be surprised if the S&P closes red on the month, which again is just holding on to a less than 2% gain on the month so far. Amazon, it's very, very close, folks. So we are, again, this right here was a false breakdown, nice validation, consistently pushing higher, validating that 21 EMA, nice validation here. And right now, we're once again at that 21 EMA. If we do get a breakdown below this level, we need to be very, very cautious and understand that, okay, there could be some more potential downside here. Tesla, on the other hand, unfortunately breaking down for the first time since May of earlier this year. So this right here, a huge red candle coming in, starting to break down below the 21 EMA. So it's going to get quite interesting how Tesla trades tomorrow and next week, whether we see a little bit of momentum coming back in or if it continues to sell off even further if the buyers step in, or if you continue to see some sell-off for Tesla. NVIDIA, very similar situation. You can see very nice consistent validation of that 21 EMA once, twice, 3 times, 4 times, 5 times, 6 times, and once again, we're coming back down to that 21 EMA. It's going to be a real test for NVIDIA as well, whether it validates or breaks down below this level. Google starting to break down once again. So Google and Tesla, 2 companies that have already broken down below their 21 EMA. Very important level to watch here. For Google, it's support at 115. We've got a small gap to fill for Google down in the 112s and 113s for this company. And then finally, Microsoft also has been validating very nicely the 21 EMA, but it's once again coming down to that support level, that 21 EMA at 341. If you do get a breakdown, well, then unfortunately, S&P 500 could see a reasonable size dip down to 4450, and wouldn't be surprised if it does see a bigger sell-off as well. Of course, if the technicals do break down for a lot of these companies and the profit taking starts to accelerate among individual investors and institutional investors. So those are some things to keep in mind. Again, long term, there's a lot of potential to unlock. Valuations are, again, 19.5, close to 20 times earnings, which again is a little bit more on the expensive side. But that being said, again, that 21 EMA is going to be that support level to watch at 4450. We're going to keep a close eye, and of course, a lot of individual stocks that are trading at their 21 EMA as well. So I hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. Link to our Discord and Patreon is going to be down below. As always, happy investing. I'll see you all in the next video.